Imagine how you'd feel if you were retired and you suddenly found out you could spend 20 to 50% more in retirement each year than what you were planning on spending. And that might be a possibility. The creator of the 4% rule, which basically says you can take 4% a year out of your retirement accounts when you're retired each and every year and index that for inflation. Bill Bengen is the creator of that. He updated his report. And instead of taking out 4% a year, he says you might be able to take out almost 5 to a little more than 7%. Now, this is not a report that's widely available. He published this in an industry magazine called Financial Advisor Magazine. And I want to share it with you because it could have implications for all of us. This article is called Cap Withdrawal Magic. And in there, Bill Bengen changes the asset allocation, not just the percent of stocks and percent of bonds. Earlier I said it was 60% stocks, 40% bonds. Now he changed that allocation. In full disclosure, this is not an asset allocation for those that are worried about volatility, and it's probably not a match for most retirees. But I do want to let you know what this report says, so it's on your radar screen and you can look it up yourself. It is publicly available on the internet. So Bill Bengen originally came up with 4%. He now calls that a safe max withdrawal rate. And by tweaking the asset allocation, not just the percent stocks and bonds in your portfolio, but specific asset classes, he now says that safe max is almost 5%. It's 4.7%. And when he looked at the study with this new asset allocation, the difference is quite dramatic. In fact, the new average safe max is 7.25%, which some of you might remember I did a video criticizing Dave Ramsey for saying that folks can take 8% out of their portfolio a year. I think that's risky for most people. And this is risky on several fronts for many people, but I want you to be aware of this. Okay, so what did Bengen do? The first thing is, instead of having a portfolio of 60% stocks and 40% bonds, he increases the exposure to stocks. Now, for most retirees, this is probably not a match. It's probably too risky. This is not financial advice. Just want you to know about it and you make the decision for yourself. But he increased the asset allocation to a little over 90% stocks and 8.8%, a little under 10% fixed income, which is a far away from his 55-45 allocation before. He also looks at an asset allocation that has 11% allocated to small cap stocks, 11% to even smaller companies called micro cap stocks, 11% to mid cap stocks, 11% to international stocks, and 40% to U.S. intermediate term government bonds, and 5% to U.S. treasuries. Okay, and so when he looks at these allocations, now the upper safe max, the upper 7% one, is with that higher allocation to stocks, which is, it's great when it works, but when it doesn't work and the market's down, a lot of folks, this is your life savings. And for many of us, once we retire, that's it. That's all the money we're going to have. It's not like we're 30 years old and we have an entire working career in front of us to make it up. So, the nice thing about saving for retirement is we only have to hit our goal once. And once we hit our goal, then we need to protect that nest egg, right? And I can tell you that an asset allocation with 90% stocks is not going to feel like you're protecting your portfolio. Okay, here's the optimum unconstrained allocation. This chart here shows U.S. large cap stocks at 10.2%, U.S. small companies at almost 42%. You can see where it adds up to 100%, and you can see he's got less than 10% in bonds that are really designed to buffer out the volatility. This is the maximum unconstrained asset allocation. And so he tweaks it a little bit and says, you know, hey, instead of 10.25 and 8.75, let's just make everything 11%. So he changes that. So he changes everything to 11%. And in this case, instead of having a very small piece of intermediate U.S. government bonds, he has 40%. So this is more like the allocation that we had seen before, 5% in U.S. Treasuries. And in this allocation, that's the 4.7%. The one above, which is more risky, that only has a little under 4% to U.S. intermediate bonds. That one's a riskier portfolio, but it has a potential for a higher asset allocation that you can take out of your portfolio every year. I want to read one of the conclusions. He says, however, I'm not ready to give this allocation my wholehearted endorsement because I have a few concerns. For one, increasing the concentration of small and micro cap stocks in a portfolio will noticeably increase its volatility, something that might be upsetting to the investor, to say the least. Furthermore, if many people were to adopt this test allocation, it might make it where it doesn't work anymore, right? Because once a strategy's known, then it's less likely to work. So what's my take on this? You know, we have to be careful because we have a very limited data set. If you want to look at 30 years worth of data and run statistical analysis on it, well, you think about it, in order to have 30 years worth of data, the last period of time that we have that is, what would it be, 1993 to 2023. So you start at 1993 and let's say you go back to 1923. So you have really just 70 data points. It's not a lot of data points. And you have to be careful that you're not tweaking the model to fit the data. There's a lot of things that statistically make sense. You know, there's a full moon and East Coast team wins the Super Bowl and the stock market's up. There's a president that's over 6 foot tall and the stock market's up, right? There's a lot of things that are related. They're not related, but they just happen to happen. They just happen to occur at the same time. So you have to be careful that you're not finding trends and you're not baking your model to fit the data. And so there's a lot of tweaking that went on here. Now, the 4% rule, I do think it's fairly conservative. William Bengen was literally trained as a rocket scientist, an aerospace engineer from MIT. And there's parts of the 4% rule that I think are super rigorous, which if I was an astronaut getting on a spaceship, I would want things designed that way. But for instance, the 4% rule has a 3% failure rate. I think that's super low. I mean, it gives you a lot of comfort that it's probably going to work. And I do encourage you, do not use a rule of thumb to decide if you have enough money to retire, to decide how much money you can spend. I do encourage you to work with a fee-only financial advisor, a fiduciary to you that knows your situation, that can model things and come up with a solution tailored for you. But I think the 4% rule for many of us is overly conservative. It either causes us to work more years or causes us to spend less than what we could spend. There's a company called BlackRock, which is the world's largest asset manager, money manager. They manage over $10 trillion. And they did a study of retirees almost 20 years after they retired. And what they found is the majority, over half, still had 80% of their initial retirement savings, the savings that they went into retirement for. So I think many of us are sacrificing unnecessarily. Again, work with a financial advisor, find out what the right number is for you. But it's hard enough transitioning from a saver to a spender. And then you toss on top of it that maybe some of these rules are conservative. So in general, I like the fact that William Bengen has updated this. I like the move to the 4.7%, which is where you still have 40% in US government bonds, intermediate term, and 5% in US Treasuries. I like that. That feels like, for many people, that's in the ballpark, but which is table 2 in this chart. But the other one that has people over 90% in the stock market, that's probably a match for some people, but it's much more likely that it's not a match for many, many people out there. So I'm glad to see this updated. I'm glad I can share this with you on the radar screen. I'm glad I can be a voice to get this information out and put it on your radar screen. And another message that I'm glad I can put out is the importance of enjoying the journey until retirement, which is why I made this video here, which is 7 things that I want you to think about stop doing as you approach retirement. Thanks for watching this video, and I'll see you in the next one.